Good morning. My name is Myron Frans. I'm Commissioner of Minnesota Management and Budget, and I'm joined today to present the November forecast with State Economist Laura Kalambokidis and Budget Director Margaret Kelly on my right. Today we're going to provide a one-page forecast summary. Our slides that we're being presented today will be available, and also there's a forecast book that's online. MMB's forecast documents are available online at mn.gov/MMB under the tab labeled Forecasts and Updates. Well, let me start with the good news. The forecast balance for the remainder of this biennium is $1.871 billion. $1.871 billion. The first slide I want to show you gives you an overview of what we're going to be talking about today. As I mentioned, I'll go through this slide fairly quickly and we'll get into the details and the math behind some of these numbers that you're all interested in. As I mentioned, the November forecast for 16-17 now is $1.871 billion. That's the forecast balance. So after that, we allocate to the environmental funds, the closed landfill investment fund, and the Metropolitan Landfill Contingency Action Trust, totaling $71 million. Those are being paid back after we borrowed from those in the last session. And we're also allocating $594 million to the budget reserve. So the available balance after those actions is $1.206 billion that will be available for the legislature and the governor to consider for the next session, although remember, we do have a February forecast that will be released in late February or early March. The headlines that we want to talk about today are that the U.S. economic outlook has weakened and that higher expected sales and corporate taxes offset a lower income tax forecast. Professor Kalambokidis will mention the forecast in detail and talk about the revenue changes. We also want to note that the lower healthcare forecast reduces overall spending and that the long-term budget outlook remains strong for Minnesota. Budget Director Kelly will talk about the spending and structural balance that we now are experiencing in this state. What I'd like to do next is go to this page to walk through the math to show you the math behind the $1.871 billion forecast balance. So if you go to the middle of this chart, you see the forecast balance. You'll note that under the end of session, we had $865 million that was left on the bottom line at the end of session. And with the changes we're making today, that new forecast balance is now $1.871 billion. In other words, we're adding $1.006 billion to the previous balance. So let's go back up to the top of this chart. The first column shows you the end of session numbers, and the next column shows you what we're saying today is the November forecast, and then we have the change column. You'll see that we're beginning a new balance for 16 and 17 based upon the close of fiscal year 15. We're adding $682 million to the beginning balance of 16-17 based upon the end of the closing of fiscal 15. That is made up primarily of revenues in excess of what we forecasted at the end of fiscal 15, and it's also made up of some spending changes and reductions. Then if you go to the rest of these lines, you'll see that revenues for the remainder of this biennium are increasing by $90 million. Spending is being reduced by $249 million, which is, although it's shown as a negative here, it actually adds to the total of the 1.006, and we're also making some small budget reserve changes. So when you add all those together, that's the $1 billion that we're adding to the previous balance of $865 million. So after you get to the $1.871 billion, then you go to the next several lines and you make those allocations to the environmental funds that I mentioned and also the budget reserve allocation of $594 million. Just to make sure you understand the math, if you take the $1.871 billion, subtract out the $71 million allocation, we then multiply the $1.8 billion times 33%, and that yields $594 million that goes into the budget reserve. Therefore, we have a budgetary balance going forward of $1.206 billion. What I want to mention now is that The next slide shows you the budget reserve changes. You will recall that in the session of 2014, we added $150 million to the budget reserve account, and in last November, we added $183 million to the budget reserve account, like we're doing today with the automatic law change. So that showed that in the end of last year, we had $994 million in the budget reserve account and an additional $350 million in the cash account. What I want to point out is that the automatic budget reserve account is only for the budget account itself. The $350 million cash account remains in place, but we're working toward a $2 billion target for the budget reserve account based upon the budget reserve report that was issued in September. So after today, we will have $1.597 billion in the budget reserve account, and we will have $350 million in the cash account that remains. This total now gets us to a total of 1.946 if you add those two accounts together, and this is what some people call the rainy day fund. A lot of the a lot of the rating agencies view the cash account that we have and the reserve account collectively because they're available under different scenarios for use, and that is now $1.946 billion. This is the largest amount of money we've ever had in the reserve account combined with the cash account. One of the reasons this is so important is, like any business, government needs to prepare for unexpected downturns or unexpected occurrences that may happen in the future. We don't know how long these forecasts will remain positive. We do know that the extent to our ability to respond to changes is really incumbent upon us to have an adequate amount in the reserve account. The rating agencies also take a very close look at both our budgetary balances, and they also take a close look at the amount of money that we put aside for our rainy day fund. And clearly, when the time to put money in a rainy day fund is when it's sunny, like it is outside today, but it's a sunny economic forecast we have here, and now is the time for us to set aside money in the advent of any particular unforeseen circumstance in the future. One of the other things that I've heard a lot of business people tell me is that they want to make sure that the state of Minnesota has a consistent and steady budgetary course where there are no surprises and that they can count on the state to be able to pay its obligations. There are a lot of states that would be really happy to have this kind of a forecast today. The overall budget forecast, which includes this new budget reserve account, is good news for Minnesota. I'm going to ask Dr. Kalambokidis to talk about the economic outlook and Budget Director Kelly to talk about the budget outlook, and then I'll have some comments at the end.
So the chart here that you see here is the U.S. economic outlook. So the bars represent real U.S. GDP growth, the history, and then the forecast going forward, 2015 forward. This is a forecast from Minnesota's macroeconomic consulting firm, IHS Economics. And we're comparing the economic forecast that informed our revenue and economic forecast in February. So the gray bars are IHS's February outlook, and then the dark bars are their November outlook. So 2015, the largest change you can see is the change in 2015. 2015 had a slow start. That was due to some temporary factors, partly due to some temporary factors, for instance, cold weather on the East Coast, slowing construction and some transportation on the East Coast, and then a dock or shipping disruption on the West Coast. Those things helped to reduce growth in the first quarter of 2015, and that reduced growth brought the whole year down. But that wasn't the only thing that happened. When I spoke to you in February about the February outlook, I talked about two developments that were shaping the U.S. economic outlook for 2015. And one was sharply lower oil prices, and the other was the strong U.S. dollar. So both of those factors have taken more of a bite out of U.S. economic activity this year than had been expected in February. And so that's also part of the 2015 change in expectations. So of course, the lower oil prices is a mixed blessing, right? So that's lower gasoline prices for consumers, that keeps down consumer prices and gives consumers a little more money to spend on other things. The mix there, though, so that's the good news. The challenge with the low oil prices is that it has slowed drilling and exploration activity, and that has reduced capital expenditures, equipment expenditures, by businesses involved in the energy industry. And that has reduced business investment relative to what it had been in the February forecast. In addition, the strong U.S. dollar makes imports cheaper in the U.S. and makes U.S. exports more expensive abroad. And so the strong U.S. dollar has reduced the demand for U.S. exported goods by other countries. That means that change in demand, that reduction in demand for exported goods, has been felt by manufacturers, commodity producers, including agricultural commodity producers. So the domestic manufacturers and suppliers of those commodities have felt that pinch, and that's also been felt here in Minnesota. So those factors have restrained overall U.S. economic activity this year. So you see the biggest changes in 15. The annual growth rate changes in the other years is relatively small. But the fact that that 2015 change brought that base level of activity down means that overall the outlook is weaker than it had been in February. So those factors have restrained U.S. economic activity, but the U.S. economy has been weathering them fairly well. The economy has added nearly 3 million jobs at the U.S. level in the past year, which is some of the strongest growth since the late 1990s. And the U.S. unemployment rate is at 5.0%, which is 0.5% lower than it was a year ago. So that healthier job market, together with the low gasoline prices and improved consumer finances, those things have revived consumer spending in the past 18 months. So regarding the forecast, so the outlook has 2015 real GDP growth at 2.4%, holding the same level of growth as last year, and then picking up to 2.9%, and then down a bit to 2.8%. The IHS macroeconomic outlook informs our forecast. Then we produce a forecast of Minnesota's economy. But let me talk about some of the dependencies or risks in the IHS U.S. economic outlook. Some of the things that they are assuming are going to happen, and if those assumptions don't hold true, then there will be changes in the outlook. And one is they expect those stronger labor market conditions to translate into improvements in demand for housing, so continue the housing recovery. And they expect that to translate into some labor force growth, so bringing some people into the labor force who are attracted by the stronger job conditions. They expect productivity growth to return to the long-term trend of 2% per year, and that should also translate into stronger wage and salary income growth. We are in a period probably at the very end of a long and extraordinary period of monetary policy accommodation, so accommodative monetary policy with interest rates having been kept low by the Federal Reserve since the financial crisis. And the IHS economics forecast assumes that the Federal Open Market Committee will begin increasing federal funds rates at their next meeting, which is later this month. That's a common expectation, and the expectation is that embedded within this forecast is that change from accommodative monetary policy to more normal monetary policy occurs smoothly. That's not a foregone conclusion. That could happen. There are lots of things that could happen to make that more of an uneven path. So that's one of the dependencies of this forecast. They assume that federal fiscal policy does not detract from economic growth. They assume that an omnibus spending bill is passes the U.S. Congress that is consistent with the parameters of the Bipartisan Budget Act of 2015. And then finally, while the IHS outlook expects relatively slow global economic growth, it depends on no additional slowing from unforeseen international events. Minnesota's economy, while continuing to add jobs, faces many of these same challenges or risks. In particular, the goods-producing part of Minnesota's economy, manufacturers, the mining industry, and farms, agriculture, have had a tough 2015 as Minnesota producers adjust to lower commodity prices, and that includes iron ore and it includes agricultural commodities, the strong dollar, which weakens demand for exported goods, and generally weak global growth. On the other hand, the service side of our economy, in the state's service industries, including healthcare and professional and business services, continue to add jobs at near the U.S. pace. So those factors that are affecting the U.S. economy are also influencing Minnesota right now, but in addition to those recent external challenges, long-anticipated demographic changes are slowing Minnesota's labor force growth, which is hampering the state's ability to increase employment. So in order to increase employment, to have employment change, you need both a job and you need a person in the job. And so at this point, the slower labor force growth for Minnesota is limiting our ability to add jobs. Minnesota has added more than 50,000 jobs since employment surpassed the pre-recession peak in 2013, and the state's unemployment rate was down to 3.7% in October. That's matching the low rate that has prevailed since mid-2014. But in order to continue to grow employment in the state, we need both demand for and supply of jobs. And this chart illustrates that relationship. So the gray bars on this chart show the number of unemployed people by calendar quarter, and the dark bars show the number of job vacancies by calendar quarter. And so an element of the job vacancies being demand for labor, the job unemployed being a measure of the supply of labor. And what you can see is that since the recession and recovery and expansion from the recession, the number of unemployed people has steadily fallen. And in recent quarters, the job vacancy rate has gone up significantly to the point where we are very close to having a one-to-one relationship between number of job seekers and number of available jobs. The job vacancies is at about 98,000 and unemployed workers is about 111,000. The job vacancy rate is 3.7%, the second highest on record. This is what I mean by a tightening labor market where some demand for labor is going unmet. This is not to say that every person looking for a job in Minnesota is having an easy time of finding a job, because there are mismatches between, potentially there are mismatches between where the jobs are and where the people are focusing their search, mismatches between what employers are looking for in terms of experience and training and what workers actually have. So under these conditions, both employers and job seekers are looking for creative ways to make a satisfactory match. Now, demand for labor in excess of supply of labor should put some upward pressure on the price of labor or per worker labor compensation. And that's the subject of the next chart. So our forecast calls for Minnesota's expansion to continue over the next several years. But both employment and wage and salary income growth are expected to remain modest in 2016 and 2017, with average wage income slowly accelerating. So let me explain that through this chart. So the top line number here, the blue line on this chart, is total wage and salary income growth annually. So per year, how much does the total payroll of the entire state of Minnesota change? And what we've done, for the one thing to notice is that in the forecast, which are the years after 15, the years that have the stripes, in the forecast we have relatively modest growth in total wage and salary income. And again, that's the aggregate growth. Now, we've also broken down in the bars, we've broken down total wage and salary income growth into its components. And the components are employment growth, so the addition of the number of people working, and that's the dark part of the bars. The light part of the bars is compensation per worker, or wage and salary compensation per worker, or average annual wage growth. And what you can see is that going forward, as demographic changes are slowing the labor force growth, that is slowing our employment growth, and so the dark parts of the bars are getting smaller. But because we're continuing to forecast moderate total wage and salary income growth, that means the average compensation, average wage and salary income is growing faster and is accounting for a larger part of total wage and salary income growth. With regard to our forecast, so the bars you see that are striped, those are our forecast. I don't have numbers on there, but regarding the change in the forecast of wage and salary income growth since February, we used information from the Bureau of Economic Analysis, the quarterly census of employment and wages, and Minnesota's own income tax withholding collections, and all that together suggests that growth in total wage and salary income has been weaker this year than what we forecast in February. And that slower wage income growth is forecast to continue. So annual wage growth in 2015 is now expected to be 4.9%, and that's down from 5.4% in the February forecast. Annual wage growth in 16 and 17 is projected to be 4.5 and 4.8% respectively, compared to 4.8 and 4.9% in the prior forecast. Now that lower forecast of total wage and salary income growth influences the income tax forecast, which I will turn to now to talk about the revenue forecast. So as you heard from the Commissioner, forecast revenues are up in 2016-17 for the current biennium. This is forecast change, and positive changes in the general sales tax, the corporate franchise tax, and other tax revenue offset a decrease in the forecast for individual income taxes. Total tax revenues for the biennium are forecast to exceed the prior estimate by $102 million. And again, that's because of the offsetting nature of the corporate sales and other. Individual income tax receipts are now forecast to be $110 million less than the prior estimate. We are still forecasting growth biennium to biennium and year to year in individual income tax receipts. It's just that the forecast has been reduced relative to February. And lower forecast growth in both wage and non-wage income. And some of the non-wage income there is lower forecast growth in capital gains income, interest income, which isn't a surprise since in February, IHS Economics and others expected the Fed to be moving interest rates in the middle of this year, and so interest rates would have gone up by now. So interest income has been lowered, and farm income has been lowered for those years as well. So lower forecast growth in those income components offsets an increase in M&B's estimate of tax liability for 2014. So our income tax forecast starts with an estimate of tax year liability, tax year 14 tax liability, income tax liability, and we have to estimate that. So you think that at this point, tax year 14 would be over, but it isn't. All of the returns have not been processed for tax year 14, and so we have to estimate what we think that liability is, and then we forecast from there. By the time of the February forecast, we'll have complete information about what that tax liability is. So among the major tax types, the sales tax shows the largest dollar amount increase over the prior estimate, that $91 million. And that change reflects higher than expected sales tax receipts at the end of fiscal year 15 and somewhat stronger projected taxable sales growth. The corporate franchise tax increase as a result of changes both on the gross payment side and the revenue side. I want to talk about some of the risks to this forecast. I've talked about the risks that IHS, or the assumptions that IHS is making with regard to monetary and fiscal policy. International trade continues to pose a risk and uncertainty on both sides. So unexpectedly faster growth among our trading partners can increase demand for U.S. exported goods and Minnesota exported goods, and that could raise the forecast, and the converse is also true. I said that IHS assumes that stronger labor market conditions in the United States will improve labor force growth. That's one of the risks for the U.S. economy. And for Minnesota, I talked about the slowing labor force growth, slowing employment growth here, limiting employment growth here in Minnesota. At both levels, we do expect increases in labor productivity back up to longer-term rates, and if that doesn't happen, then that will change the forecast. And of course, we talked about low commodity prices being a challenge to exporters of those producers and exporters of those commodities this year, and so that could raise or lower the forecast if that changes. I talked about our wage and salary income forecast, and if wages and salaries grow faster or slower, that will be an impact. Capital gains is the most volatile income component that we forecast, and so even small changes in the growth rates for capital gains can change the income tax forecast a lot. And then finally, I just want to point out that the forecast I'm talking about is for a biennium that just began a few months ago, and so we've only seen collections for about 14% of the total amount of receipts that we expect to get in that biennium. So there's a lot of receipts left to be collected in the time remaining, and a lot that can happen. So I'm going to pass this to Budget Director Kelly.
I'm going to speak about the spending side of our forecast. We are seeing a significant reduction in healthcare costs, and that is driving our expenditure forecast this November. These savings in healthcare are offset by expenditure growth in education and other areas of state government. But overall, spending is lowered by $249 million. That's the total spending before allocations line. So before we make those statutory allocations that were triggered in this forecast, $249 million of savings. The enacted budget from the regular and special sessions last year borrowed $71 million from two environmental funds mentioned by Commissioner Frans to support the general fund spending included in this budget. So the forecast balance was dedicated in statute to repay those funds. So we, in this forecast, we are allocating $63 million to the the CLIF fund, Closed Landfill Investment Fund, and $8 million to MILCAT, which is the Metropolitan Landfill Contingency Action Trust account. 71 million total. That actually counts as increased spending in fiscal 16, so that lowers our overall savings that we're seeing in this forecast down to $178 million of savings, below end of session estimates. Education spending, E12 spending is up by $73 million. That is just a 0.4% increase in spending overall. And this increase is primarily due to student growth. Our general education aid is paid out based on pupil units, and that's driven by the number of students we have in schools. And the projections for pupil counts is revised in this forecast based on actual experience. So if we look here, you can see our forecast for student growth this November, which is the dark line on the top, compared to February, the most recent forecast, which is the dotted line on the bottom, and the previous to that November forecast, which is the dashed line. So we're seeing pupil counts are expected to continue their growth, and we're also seeing them grow at a faster rate than we had previously forecast. Back to the table. Property tax aids and credits are increasing just minimally, $6 million, or 0.2 percentage point increase. Property tax refunds are up by $14 million due to an increase in the number of returns being processed, but also the property tax burden is outstripping personal income growth. And this trend does not continue into the next biennium. These savings are partially, or this increase is partially offset by savings in other areas in the property tax aids and credits, specifically a 31% reduction in the targeted tax refund program, which is a volatile program, and we see that change frequently. Overall debt service projections are lowered by $27 million in this forecast. We sold bonds in August, and the market was much more favorable than we had anticipated. And we lowered our debt service costs this biennium and by $21 million, and that continues into the next biennium as well. We also refinanced some of our existing debt and saved an additional $6 million by doing that. And these savings also continue into the next biennium. All other spending is up by $115 million, and in part that's due to the contingent spending that was included in the enacted budget. Our positive close for fiscal year 15 triggered $22 million of additional spending in fiscal 16 to fund the disaster contingency account. And that was funding that did not get included in the enacted budget, but language was included to make sure it happened with a positive close of the fiscal year. And that was for disaster and also avian influenza. So let's go back to the Health and Human Services line. Overall spending here is lowered by $416 million in this biennium. That's a 3.3 reduction in spending, which is a little larger than we typically see in a forecast. Almost all of this savings, $415 million, is in the Medical Assistance Program, or our MA program. So state savings or state spending for families and children, along with adults without children, that's our PMAP program, our Prepaid Medical Assistance Program, or our managed care element of MA. That fell by $360 million, or 12% in fiscal year 16-17 from our end of session estimates, which is a significant savings. It's driven by a couple of things. One, competitive bidding was responsible for $158 million of that savings, and it makes up about a 5.2% decrease from end of session estimates. Other payment reductions related to healthcare utilization, how healthy the enrollees were, the cost of care, all account for the balance of the savings from $360 million. That's $202 million for other cost savings. The other component of our Medicaid program is elderly and disabled, and the basic care program there for that enrollment group grew less than expected as well, lowering our forecast by $111 million in that element. I'd like to talk for a minute about Minnesota Care, because we're seeing some of these cost changes in the MA program reflected in our Minnesota Care program as well. State spending for Minnesota Care fell by $429 million, which is 57%, an incredibly significant reduction in our Minnesota Care program. Competitive bidding was responsible for a small piece of that, about $75 million, not as much as in the MA program. But the majority of the savings in Minnesota Care come from lower cost experience, along with higher federal payments. $354 million of the savings is coming from those two categories. So new enrollees are healthier than we had forecasted they would be, and so that's bringing our costs down. But as healthcare premiums and healthcare rates in the marketplace grow, federal participation in our basic health plan also increases, so that saves state funding on that side. If you look at these two groups combined, Minnesota Care and MA families and childless adults, spending fell by 21% overall compared to end of session. This graph here shows you how our total healthcare spending has changed in the last couple of years. So it includes both the MA program and the Minnesota Care program, both general fund and healthcare access fund. If we start with the solid line across the bottom, that represents our current forecast, and the dotted line across the top represents the trend from the end of session in 2014. And as you can see, there have been significant reductions in spending over the last year and a half. Between the ends of the 2014 and 2015 legislative sessions, which is the white area of the graph, we saw significant reductions in forecast spending, primarily due to lower than anticipated managed care rates and also in changes in basic care enrollments. So as individuals, we anticipated people would enroll in the elderly and disabled category, but they actually enrolled in the adults without children category, which is less expensive. And we talked about this in previous forecasts. The two gray areas represent changes in this forecast since the end of session, and one major contributor to the lower spending is the competitive bidding that was recently announced for the 2016 managed care contracts, and that's the light gray area. And these contracts cover 800,000 individuals. These families with children and childless adults in MA and Minnesota Care programs make up 85% of our enrollment in those programs, yet they only account for 30% of our state costs. So competitive bidding lowered state spending for these groups by more than 6%. The darker gray area represents other cost savings that we are seeing reflected in this forecast. The average cost going down, healthier individuals, meaning less expensive costs of care. The elderly and disabled make up about 15% of program enrollment, but they account for 70% of our program costs. And while we've seen some savings within this forecast, in this enrollment group, from both enrollment patterns and the cost of care, we often see additional investments during a legislative session in this area as well. For example, last session, we saw nursing facility rates increase, which added $138 million of costs to this budget period. Only $111 million of savings in this forecast. So moving on to what's happening in the out years, the next biennium, fiscal years 18 and 19. This table shows the structural balance. So it compares the ability of our revenue stream within a year or within a biennium to support our spending obligations within that same time frame. It doesn't look at other resources or reserves. In the 16-17 biennium, we have $1.62 billion in positive structural balance, and that continues into 18-19, where we see a $2.046 billion positive structural balance, and this is a great financial position to be in. With that, I'm going to turn it back to Commissioner Frans.
Thank you. Just a few concluding remarks, and I don't know if the governor's ready. We'll be able to bring the governor up, or have maybe a few questions before the governor comes up. As I mentioned back in February, when the news was very similar, I said we have righted the ship, and I can tell you today that the ship continues on course, and we are improving the stability and control of that ship by adding ballast in the form of $594 million to the budget reserve, which brings the total budget reserve to its highest level ever. Remember that 6 years ago in 2009, 4 years ago in 2011, and just 2 years ago in 2013, we faced deficits and owed billions of dollars to our schools. Over the last 5 years, Governor Dayton has focused on responsible fiscal management. We paid back our schools, we enhanced strong revenues for the state, we strategically invested in education and training, we carefully managed our state budget and controlled spending, we increased our reserve to an all-time high, we implemented strong management techniques such as renegotiating healthcare contracts both in the previous 4 years and just recently, as Budget Director Kelly mentioned. Minnesota is a success story. We have a balanced and diverse economy. We have the 8th lowest unemployment among the states and a growing economy. We also have a high reputation for a high-quality workforce. Our fellow Minnesotans have earned this reputation the old-fashioned way. They worked for it. The business community has responded by moving here, expanding their businesses here, and investing in and staying in business here. We thank all those who invest their time and capital in this state because we all benefit when they do. This forecast reminds us that we must continue to grow our workforce so that we will have the talent that businesses need in the future. Let's be clear, Minnesota is competing with all the other states, and we're competing with other countries for workers now and in the future. We must continue to focus on investing in Minnesota in ways that will enhance our competitive edge and build the world's best workforce. Minnesota continues on a path of economic growth. We can do more, and we must expand opportunities for everyone in Minnesota. Do we have time for questions? I think before. Let's have a couple questions, and we'll, I think the governor, let me know if the governor's here.
How much of this money should be deemed as one-time money? I'm thinking of the amount that's available for the legislature to spend. I'm particularly interested in the balance at the close of fiscal year 15 of the $682 million of revenue that exceeded the forecast. Is that one-time money?
Yes, if you look at this chart, you can see that the $865 million that was there at the close of session, and then $682 that was at the close of the fiscal year 15, Those are both what we would call one-time sources of money, and they're both sort of in the bank. The other money that adds to the $1 billion, that's what we call future growth in the next biennium. Remember, this is the growth through July or June 30, 2017.
Modest wage growth expected chart there, which talks about the decreasing contribution from employment growth. What's the risk factor there for the next biennium that we're talking about in terms of potentially deviating from forecast in a negative way?
You mean in terms of the economic risk associated with that? Maybe I'll let Professor Kalambokidis answer that.
So the growth that you see in that chart, that's in our forecast. So it's already in our forecast. And we have projections that you can look at in the book for the next biennium as well. So there's risk around all of the forecasts that we do, and so that could, if we get an unexpected influx of people, that could change. But the slow labor force growth that has been anticipated for a long time due to demographic change is baked into this forecast now.
From your assessment as an economist, what do you think the risk is of it being lower than forecast and therefore impacting the budget in unexpected ways?
There are risks on both sides of all of these variables, so I can't really. This is our best estimate right now, and it could be different going forward.
While you're up there, talk about the future of commodities, the mines, the ag, and also manufacturing. What are the hopes of that in Minnesota? What are the hopes of those things increasing? Looking better?
Yep, improving. The fundamental factors that are influencing this have to do with uneven global growth, and in particular a slowdown in China. There are some countries that are growing quite well, but the slowdown in China and uneven and slower global growth abroad raises the value of the U.S. dollar, and so that reduces the demand for U.S. exported goods, including manufactured goods and commodities. And so that differential right now between U.S. economic growth and the rest of the world is part of what's driving this. And so in a way, what we need is, you may see in Congress, but to cheer on our trading partners, because the more that other countries' economies grow, the greater the demand can be for the things that we're producing. So that's part of what's driving both the agricultural commodities and the iron ore down. Another thing that has been driving the price of iron ore down is an increased capacity for producing iron ore in other parts of the world. So going forward, the thing that can help improve that in all of those cases, manufacturing, agriculture, and mining, is stronger growth abroad.
And should we be cheering on China too?
If you're a Minnesota manufacturer who's trying to sell to China, then I would ask the manufacturers trying to sell to China who they're cheering on.
Can you elaborate a bit more on the state's current economic conditions and how they compare to previous points when the state was at or near full employment?
The notion of full employment is more salient at the national level, because the idea there is that the labor market is so tight that if you're going to increase inflation by lowering the unemployment rate anymore. That's less relevant at the state level, because we as a state can't move the national inflation levels. But what we're saying is that we're at a point now where we think that additional growth is pushing wages and salaries up. So not general inflation, but we do see growth in average wages. So that's the condition that we're looking at, both that slowing labor force growth is limiting our employment growth, but it is also expected to bring higher average annual wages.
You said that there's some jobs Doctor, you said there's some jobs mismatches, that there are people who want jobs who can't find them in their area or without skills. Where in the state do we see this distinction, and where are those gaps?
Yeah, I don't have the specifics on those gaps, but the one thing I can say at the moment is that, well, for instance, the job vacancy rate is 3.7% at the state right now, and in the most recent data, the second quarter of this year, that rate was actually higher in Greater Minnesota than in the city, in the Twin Cities area. So beyond that, I can't really speak to the specifics, but yes. So the specifics are available in the job vacancy survey report produced by DEED. So they describe the geographic differences and the occupations in demand, that kind of thing.
I have heard we have time for more. I'm not trying to generate more questions, but we do have time for more if you have any.
As long as you're up there and the word stadium is about 2 feet tall, can you talk a little about the stadium reserve?
Yes, I can. The stadium reserve, one of my favorite questions. Now, we show that the stadium reserve is going to improve by $6 million, but it's important to remember that this is a dynamic reserve and it's constantly changing. So right now we're showing what's projected for the end of this biennium, but as dollars flow into this reserve, they soon flow out in order to pay for the bonds that were issued to construct the stadium. So this will constantly be changing throughout the biennium. So if you drive by the stadium, obviously it's there and it's going to be completed in this next year. So the stadium reserve simply reflects the use of funds over time to build the stadium, and this just shows our estimate that at the end of this biennium we'll have an additional $6 million in the reserve, but it's going to change on almost a monthly or daily basis.
Did you mention how much of a bonding bill that this forecast could support?
The governor has talked about a bonding bill of $1 billion or more. This particular forecast supports a much larger bonding bill. We have a number of different guidelines that we try to measure in terms of the outstanding debt we have and also the debt that we've actually sold. Under either of those different guidelines, the state could issue several $billion worth of bonds and still be under the guidelines.
What's the downside of issuing that many bonds?
Well, that's a good question. You don't want to overuse your ability to borrow, but on the other hand, the rates are low and are lower than they have been in a while and continue to be. And the other thing that I think you want to make sure that you do is that you match your bonding projects with those things that are actually needed, that actually produce value, jobs in different locations. So you never want to overuse that. The rating agencies look at our debt capacity, and as long as we're within our guidelines, they're not so concerned about it as long as we maintain the guidelines. So we have some flexibility in what we can issue or sell. And as Budget Director Kelly mentioned, we had a good sale this last August. And, we think, and the Standard & Poor's said this in their rating agency outlook, when they raised our outlook from neutral to positive, they said if we continue along this path in terms of balanced budgets and putting money into the reserve, they think we're on the path to restoring our AAA credit, which would further reduce the amount of money we would have for the cost of the bonds.
Another topic that will play in, I'm sure, into the upcoming budget negotiations. Actually, on the second slide, I think, where the summary slide where it says higher expected sales and corporate taxes offset lower income tax forecast. Why is that? Are employers not passing through some of their gains in terms of revenues to employees, or what's the dynamic that's going on there?
Well, I think Professor Kalambokidis talked a lot about the dynamics and the fact that with the economic activity we have, we're seeing increased profits by corporations, we're seeing increased economic activity, therefore more sales activity, and with the slower workforce growth, that's where we're seeing a diminishment in the projected income taxes. So it's really a direct result of the workforce element that we're seeing and the pressure that's being put on our workforce to grow in the future. So those are the dynamics in play, much more so than whether employers are holding or paying money out.
We're already hearing a lot of groups and folks lay out their plans and requests for how to spend this surplus. How much are you stressing the weakening U.S. economy and its, ability to change that number by February, and as a way to say, hold on, folks, don't cook up plans to send this 1.2 billion out the door just yet.
Well, if I could restate what you just said, I think that would be good. Clearly, what we have is a cautionary tale. We're in really good structural balance. We're able to put more money into the reserve. There are a lot of good things. As I mentioned earlier, a lot of states would love to have this economic forecast. On the other hand, as you go into the second year of a biennium, if you spend $1 in 2017, in fiscal 2017, and it's an ongoing expenditure, then that's $2 in the next biennium. So you have to be careful because of that dynamic. But I think what we are seeing with the projected growth for the remainder of the biennium is some caution, and I think that's what a lot of folks are going to want to do. And I think one of the reasons we want to be careful today is that with the new February forecast coming out in late February, early March, we'll know a lot more about 2014, we'll know a little bit more about 2015, and I think that's why we really want to caution everyone to wait until the final numbers come in February to make those final determinations.
At this point, what would you recommend to your boss that be spent out of this 1.2 billion?
I think my boss can speak for himself on what he would like to, what we recommend is that we look at the long-term outlook, we look at the inflation factor in the next biennium. We have to make sure that we want structural balance for this biennium and the next biennium. The governor understands that we look at the rating agencies are looking at us, and as well as there are pressures to spend money in ways that help people in Minnesota that need help. So those are the tensions that he has to deal with, and I'm sure he'll let you know in just a few minutes.
Do you need a bigger rainy day fund?
Yes.
How much bigger?
Our rainy day fund is targeted to be a little over $2 billion, which would be about another $435 million. So that's what we would say in terms of the volatility of our revenue source. If we had that much more money into the fund, we would be more happy, I suppose is the way to say it. And remember, there is no reserve adjustment in February. The February forecast does not have this automatic reserve adjustment. Only the November forecast does.
Could you talk a little bit about the expected reduction in the forecast for individual income tax, where that comes from? And can you also, how are we doing on the three-legged stool right now? If you project it for 2018, 2019, it seems like we're tilted.
Well, one of the things that when we started talking about trying to balance our revenues, our property tax revenues, our sales tax revenues, our income tax revenues. At the time, several years ago, the property tax leg was really out of whack, and that's the most regressive tax. And one of the things that we wanted to do and we wanted to accomplish was making the system more progressive. And that was one of the reasons why we wanted to strengthen the income tax portion of that three-legged stool to make sure that we had a more progressive, more fair tax. I think what we're seeing now is with the growth in sales tax, we're seeing some vibrancy in the sales tax, but a lot of people talk about there are different ways we could expand or make that more stable. But I think we're seeing some balance there. I think Professor Kalambokidis, described aptly that the reduction, that there's growth in individual income tax in the next biennium. It's just not growing as fast, primarily because of the workforce issues that we have to deal with and the fact that we're just not being able to employ all the people, fill the jobs that are there. If everyone could fill all those jobs, then we would see a different picture. I think we're ready for my boss. Thank you all very much.